All right, I want to try something with you. Let's just assume you have $100,000 and you're deciding, do I put this money in a 401k or my retirement account, or do I do something like the infinite banking concept? Now, most people don't actually compare these. They just follow the default path, the path that they've been told their whole life. So today, what I'm going to do is I'm going to put them head to head. 401k against infinite banking concept. Same dollars, same person, same timeline. And what we're going to do is we're going to see which one actually holds up. Why not? Never did this before. Let's give it a whirl. Round one. Money goes into the stock market, into the market. When it goes up, you win. When it goes down, you wait. Sounds simple, right? But here's the question. What happens if you need that money during the downturn? What happens if there's an emergency? Just keep that in mind, okay? The infinite banking concept. Yeah, it's not tied to the markets at all. The growth is steady, it's predictable, it's partially guaranteed, and there's no big spikes, and there's definitely no sudden drops. So right away, you've got one system tied to timing and one that isn't. I think that's a simple analysis. But that's just the first layer. Let's look at round two. You get a tax break today in a 401k, and that sounds great. You get a tax deductible contribution into it. But later, when you go to use that money, you're going to be taxed on everything. Everything meaning the amount you put in plus all the gains. So the real question becomes, what do you think taxes are going to look like in the future? Are they going to be lower or higher? You already know the answer for that. Let's talk about the infinite banking concept. It's structured differently. You're not deferring a tax bill. You're not getting any tax advantage for putting money in. You're changing how you access the money. So now you've got one system where the tax bill is waiting for some future date, where in that future, your taxes are probably going to be higher. And then you got one where access works completely different and has tax advantages. But there's still no clear winner yet. Round three. Let's talk about costs. I think if you were to ask people about the fees, and the costs in their 401k, they wouldn't even really know because the fees are hidden. They'd think they're cheap. They're not obvious, I think is the best way. They're just quietly reducing your growth over time. There's all sorts of papers on this. And then the infinite banking concept, there's structure, you see it, you understand it. So now the difference becomes visible cost versus invisible cost, because within the specially designed whole life, the infinite banking concept, the costs are pretty easy to articulate. And that probably matters more than people think. Let's hit round four, freedom. The 401k, okay, the retirement account, if you will, the money's locked up to a date in the future, 59 and a half. There are rules, there are age limits, there are phase outs, there are penalties if you take the money too early. So if you want to use your money early, well, you're either restricted or you're going to pay a penalty. The infinite banking concepts, you want access, you use it, you have them. No permission needed, no waiting necessary, no real rules for that, all intents and purposes. Right in that moment, you could access your money. And this is usually the moment where people start asking, wait, do I actually control my money? Well, let's keep going. Round five. What happens when you use the money? Now, this is the part that nobody really understands, or they think they understand, but they don't really understand. The 401k. When you take money out of your 401k, withdrawal or loan, the money stops working. Either equation, your money stops working. It's no longer compounding. It's gone from that system. In the infinite banking concept, your money continues to grow. It earns uninterrupted compounding interest whether or not you're using it or not. So now you got two completely different behaviors. One where using your money can slow or kill the growth, and one where it doesn't affect the growth at all. Just sit with that for a few seconds. Round six, penalties. Kind of hit this earlier, but let's get deeper into this. With the 401k, if you use it early, you're going to pay taxes, early withdrawal penalties, and there could be restrictions. With the infinite banking concepts, there are no penalties. Okay, you've just stacked everything side by side, and, well, let's zoom out for a second. So I've seen people with hundreds of thousands of dollars, millions of dollars in 401ks. They're doing everything right, so they think. And then life happens. They still have to go into debt just to access their money. Think about that, okay? They had all the money, but they still had to borrow it. Which raises a bigger question. What's the point of having money if you can't actually use it when you need it? Here's the reality. The 401k is simple, it's automated. Set it and forget it. I mean, that's why most people do it. And for a lot of people, it feels safe. It feels safe, comfortable, they're just familiar with it. But that simplicity comes with trade-offs. Limited access, limited control, exposure to market timing, future taxation, and no real legacy strategy built into it. The infinite banking concepts is different. It's more intentional. It's more hands-on, and some people aren't going to like that. But it gives you control, it gives you access, it gives you flexibility, and most importantly, in my opinion, it gives you uninterrupted compounding growth. So when you actually compare them side by side, which we're going to do in just a second, one is built for accumulation, the other is built for control. So I want to just walk you through this because there's the two side by sides. We're going to do the 401k and using that, and then we're going to use the infinite banking concept. I'm going to keep this like 5th grade level. So for some of you, you're going to be like, oh, you missed this, you missed that. Let's just keep it simple. Let's just assume you got a qualified retirement plan. QRP means qualified retirement plan, but we're going to just focus on 401ks, but that also could be a 403b if you're a teacher or work for a nonprofit, or a 457 plan, deferred comp, or whatever you want to call it. That would be a government employee. But nonetheless, first and foremost, you have to check with your plan administrator to make sure that this is allowed with your plan. That's the disclaimer. If you had a 401k and you were allowed to take loans from your 401k, there are rules. Remember back when I was explaining it, the restrictions and the rules. So here's the rule. Typically, you can take $50,000 or 50% of your balance. So it's either $50,000 or 50%. And that is the first rule. So if you had a 401k that had $100,000 in your 401k, you could take out 50 grand because that's 50,000 or 50%, and that qualifies for both, keeping it simple. Now, when you take a loan from your 401k, there are some things you need to understand. Taking the loan means the money comes out of the market. So you have to sell something. You have to sell one of your investments. So if you have a mutual fund, you're going to liquidate the mutual fund, or they're going to liquidate the mutual fund to create the $50,000 you're taking as a loan. That's first and foremost. Your money comes out of the market, which means when it does that, it's no longer making anything in the market. Or maybe on a good side, maybe it's not losing anymore. So there's two sides to that. The second thing is when you take a loan, you are required to repay that loan to your 401k. So much so that they are going to force you to set up a repayment from your paycheck. So your payroll will have a payment for the 401k loan. Now, here's the cool part. When you go in and you model one of these loans in your 401k platform, you're going to basically model the loan over a repayment period that you pick. Could be 36 months, 48 months, 60 months. You choose that, and then per paycheck, it will repay the loan principal and interest. I left that out. They do charge interest. So let's just say your 401k has an interest rate of 8%. So you're taking the loan, $50,000 or 50%, those are the rules. You're going to pay an interest rate, and that's going to be based on probably the Fed rate or the SOFR rate, but we're just going to pretend that it's 8%, and you're going to have to repay that from payroll. So if you're paid biweekly, it's going to repay biweekly based on your loan terms, let's just call it. You get to pick the terms. So you pick those terms. So there's a couple things that are important now that we're getting into this is if you lose your job, if you leave your job while you've got this loan out, there is a provision in most 401k loans where you have to repay that in a specific amount of time, 60 days sometimes. So if you plan on leaving your job, if you think you're going to get fired from your job or there's any uncertainty, then just know if you take a loan and you don't pay it back, there's taxes and penalties. So if you didn't pay this loan back, it will be considered an early withdrawal from your 401k, which is typically a 10% IRS penalty, and you'll pay tax on that money. Or you'll have to just repay the loan in whatever time frame they give you. So are we clear about the rules? A lot of rules to remember. This is all stuff ChatGPT or Google can give you, but I need you to understand those, okay? Rules, and more rules. But let's talk about some of the good things. This 8% interest rate that they charge on that loan, when you repay it from your payroll, this payment, okay, the payroll deduction, goes back into your 401k and you keep the interest. So this 8% doesn't go to your boss. This 8% doesn't go to the 401k provider. This 8% goes back to your 401k. So even though when you took the money out, it stopped earning for you, it stopped being in the market, you're repaying it back with a fixed rate, okay? That's a really, really good thing. But let's get into the meat and potatoes of how valuable this can be with what we're talking about in this comparison. Remember, we're going to keep same for both. Same person, same dollar, same time frame for both. So let's just assume you're going to repay this loan in 60 months and you take out a $50,000 loan. So let's just pretend that you're biweekly. And listen, I'm completely making numbers up, so please don't hold me to this. But let's just say per pay period is 300, it'd actually be more than that. Let's just say it's 500 bucks. Okay, I'm just putting numbers. $500 per pay period, so that would be biweekly, is the amount that's going to come from your paycheck to repay the $50,000 loan at 8%. Again, I'm not doing the math. You can do yours. Now, what are we going to do with this $50,000? When you take a loan from your 401k, the goal should always be to have that money go to work for you a second time, because that's what we teach. That's being your own bank. So let's just assume we're going to take 50 grand and we're going to shuffle it over here. Let's get rid of this house, okay? And you have two debts. You have a car loan for $25,000. That car loan is 7% interest, and your car payment is, we'll just call it $500 a month, okay? Again, making numbers up. But you also have $25,000 in credit card debt at 20% interest as an average interest rate that you're paying the credit cards, and your payment over here is $1,000 a month, okay? So right now, this $500 a month, which represents 7%, and this $1,000 a month, which is 20%, is leaving your family forever. Never going to come back, okay? It's just the payment on the debts. You got a car in your driveway for the car, okay? But the car is depreciating terribly and you're barely keeping pace. So the amount of your loan is barely keeping pace with what your car is worth. That is the majority of you watching this. That is the average, okay? So now what we're going to do is we got 50 grand in the 401k and you are not earning this interest rate, okay? So let's just do some basic math, because this is how I would break this down. You got credit cards for 25 grand at 20%, and you got a car loan at 7%. So let's grab a calculator. We'll do the math. 20%, so you'd add the 20 plus the 7, so that's 27. Okay, got that? You got 27, now divide it by 2. That's going to give you your average. So your average interest rate is 13.5%. 20 plus 7 divided by 2 gives you your average. And you're losing cash flow of $1,500 every month that is leaving your family forever, which 13.5% interest, $1,500. So that's a pretty compelling story, and I bet you that's a lot of your situations. Might be different debts, but just do that math, and that should be the awakening. So now we're going to take 50 grand out of the stock market, out of your mutual funds in your 401k. We're going to take it as a loan, and we're going to move that 50 grand over here. And what we're going to do is we're going to pay off this credit card, okay? So the credit card debt's paid off, and the car loan is paid off. So now you own the car free and clear, and you no longer have credit cards. Now remember, don't rack the credit cards back up. So let's just keep that the same. So here's a cool thing. Now your checking account or bank account has $1,500 a month more than it did prior to doing this. But you're not done. Because remember, you had to set up a payroll deduction for $500 biweekly. So let's just call that $1,000 a month. Keeping this simple. I know that's 26 months. Anyway, we're just going to call it $1,000 a month. And it's going to come from your payroll to repay the loan. So right off the bat, the math is mathing in the positive way. Number one, you're going to recapture roughly 13.5% because that's the interest rate you were giving away on the loans. Now you no longer have to give that away. You get $1,500 a month back, but from your paycheck, you're going to lose $1,000 a month. So your delta, the positive, is you got the chance of keeping $500 a month in cash flow. That's $500 a month you could use to save more. That's $500 a month you could use to take your family to dinner and a movie more. It's $500 you could save for a vacation. You get the drift. You are making $500 extra in cash flow. But you see, the real equation isn't just the cash flow that you're making. The real equation is now we're going to take that $1,000 a month, okay? Remember, it was $1,500. $500 is going to be That's your happy money. You can do whatever you want with that. But we got $1,000 that's going to come from your paycheck, so we can't count that. And that $1,000 is going back into your 401k every month, and you are keeping the 8% interest. So how much did you make on this equation? Well, you made 13.5% there, plus you're keeping the 8%. That's not bad. That's not bad at all. Every one of you should think about doing this if you're in a situation like this. But what were the negatives? Well, the negatives are you had a bunch of rules, you have a bunch of factors to consider. You can't lose your job, you can't leave your job for a better opportunity because now you're on the hook for 50 grand back to your 401k, and if you don't pay that, you got penalties and taxes to pay. Everything good? Now what we're going to do is we're going to just change the game, okay? We're just going to change the game. I'm literally going to do the exact same thing. We're going to move some numbers around here. We're going to do all the same things, okay? Except for we're going to replace 401k with be your own bank. And this is going to be the infinite banking concept, which just so you all know, the machine, okay, behind the infinite banking concept is a specially designed and engineered whole life insurance policy. Okay, and again, I want to preface, specially designed and engineered. Again, I'm trying to keep this 5th grade level, so we're not going to get into the details. So same idea. You have been saving money, and you have $100,000 in your policy. You have 100 grand. I told you we're keeping all the things the same. You got 100 grand in your 401k, you got 100 grand in your policy. You got 100 grand by saving money. You just decided to change where your savings went first. So now we got 100 grand here. But here's the cool part. You no longer have the rules. So you don't only have 50 grand. You could borrow up to, in most cases, 90,000, about 90% of your cash value. So this is the cash value. You could borrow 90%. So you have more money you can use. You have more liquidity. The other thing, you have no real rules. Whatever you want for your terms, you can do. You could design your terms any which way, including you could even do deferred. You could not repay the loan back to the policy, which I don't suggest because that's stealing from your banking system. Don't do that. But here, the terms are 100% up to you. And nothing's going to come from your payroll, okay, from your paycheck. So none of those rules about your job, leaving your job, or any of that. But I do want to kind of keep some things the same here. I want to keep the numbers all the same, okay? So here we go. Now, if you take a loan from your policy, from your private banking system, what's going to happen is the insurance company is going to charge you simple interest. Okay? So the 401k loan was amortized interest because remember, you had to repay it back to your 401k and you had to do principal and interest. But here, it's just simple interest to the insurance company. And I'm just using 5%. This is just a hypothetical number. The rates right now with the insurance carriers goes anywhere from a little under 5% to in the 6% range. So I'm just keeping this simple. Now, we can take up to 90, but again, I said we're going to keep everything the same. So we need 50 grand to repay the credit cards and the car loan, just like I explained with the 401k. The rules are all going to be basically the same. Remember, 13.5% interest, $1,500 is leaving your family together or forever. And what we're going to do is we're going to take the loan from the policy for $50,000. Now, there's a very definitive difference between this IBC and the 401k. And here's what it is. This $50,000 that you're taking is not your money. Your whole $100,000 is still in your account, earning guaranteed interest contractually plus dividends. We call it the dividend crediting rate. So let's just kind of say that that money is in your policy, and your policy has a dividend crediting rate of 6%, just keeping this simple. So remember, you can borrow at 5 and you're earning 6. Now that's 6 gross before commissions, before cost of insurance, and before policy service fee. So the internal rate of return would be less than the 6, but I'm just keeping this simple. So again, there's a couple things you need to understand, and we're going to get to those that are a little bit more complicated. This is why earlier, remember I mentioned the vault. The vault does all of this, and we'll show you the math and the economic benefit to you. So I'm just trying to keep this simple. We got the 50 grand, but it wasn't your 50 grand because the insurance company loaned you the 50 grand from their general account and took it from your death benefit. Your money didn't get diluted. Your money is still compounding uninterrupted. That's the only important thing. Forget about all the numbers. Although they are important, I don't want to get into them. It's better than the 401k. Now, the money comes over here. The same thing happens. You pay off the credit cards, you pay off the car, you take back the $1,500 you were giving them, and we're going to redirect $1,000 a month back to the policy, because that's what we did with the 401k. But you didn't have to do the $1,000. It could have been the full $1,500. It could have been less. You could pick and choose how much, because there are no rules except for your terms. And you just got to follow your terms. But if $1,000 came back over here to the policy, this is key. So listen carefully, okay? I'm just going to erase some things here because you'll understand what numbers we're doing. $1,000 a month is coming back into your policy as a loan repayment. Exact same thing as the 401k, but now something drastically different is happening, because now $1,000 every single month is being reduced from the $50,000. So over 1 year, $12,000 would be repaid. So the 50 would not be, it would be $38,000 that is owed to the insurance company. 38 grand. So now, after 1 year of putting $1,000 back into the policy, two things have happened. Pay attention. You have $12,000 more in your policy to use the next day, which isn't really altogether too different than your 401k, because if you repaid your 401k at the same amount, hypothetically you'd have the same amount in your 401k that you could use as another loan, but most 401ks only allow you to take up to 2 loans. This you could have 50 loans out on your policy if you wanted. So again, about the same. But here's where the difference is. With the insurance company's loan, the 50 grand, when you paid back the $12,000, every month you are paying down the balance 100%, okay? Because they only charge you interest one time per year. Remember, the interest was 5%. They charge that one time a year. So you had 12 months to knock that principal down. And when you did knock the principal down to $38,000, the insurance company is charging you 5% on $38,000. This is simple interest. So let's just do the math. This is really important because your APR has gone down. It's not 5% that you actually paid, because at $50,000 times 0.05, that's $2,500 a year in interest. So here, let's just do some math. At 5% interest, that would have been $2,500 that you would lose to the insurance company. But after 1 year, and again, the Vault software will do the math, after 1 year, you're at 38, which is now $1,900 in interest, okay? So now the 5% is only $1,900 in interest because you repaid the principal, but you lost no control of your money. 100% of that $1,000 a month is available to use. So you did two things. So remember, again, if your policy hypothetically was earning 6% dividend and crediting rate and you're paying 5, you're making a spread, but now you're doing much better than that, because 1,900 divided into 50,000 bucks is 0.38%. Okay, so we'll just keep this simple. Doing quick napkin math on my calculator, you didn't pay 5% interest, because now if you divided the interest you paid, 1,900 on the 38,000 into the original 50, technically your APR was 3.8%. So your spread went up. You continued to compound uninterrupted, but you were in control of driving your spread down just by doing the same thing you were with the 401k. See, that doesn't happen with the 401k. But remember, the 401k, a cool thing is you were paying yourself back with interest, but you had all sorts of rules. Here, there's no rules except for your rules. And here, your money's compounding. So if we were to compare mathematically the two side by side over a period of 60 months, like we did, it wouldn't be a fair comparison. Because as you can see, it's not going to take you 60 months to pay down the $50,000. It's going to take you a lot less time than that, just by math. It's going to take you less time. It's going to take you a little over 4 years to repay the policy, to which, when you repaid the policy, you regenerated all the money, so you had all that money available, and you made a spread. So effectively, really, in this scenario, you made money twice on the same dollar. In the 401k, you made money once. Here, you made money twice. Plus, you got a death benefit. The 401k, whatever your balance is what your family gets upon death. But here, your family gets not the cash value, but the death benefit, which is significantly more. So you're benefiting twice on that. All I'm trying to say is if we were to compare these side by side, it doesn't really take a smart person to understand this one's going to come out better. It's going to give you more control, less rules, less restrictions, and the ability to compound uninterrupted. The Vault software allows us to do this. So listen, I know some of you are watching this being like, I need to see my numbers. Great, get on a call with us. We'll literally run your numbers into the Vault. We'll break this down for you. I just used a bunch of hypothetical numbers, but let's look at your actual real numbers. And then what we could even do is we could do a side-by-side comparison with you taking it from a 401k. This is how I like to solve problems. This is how my whole team loves to solve problems. Let's not guess. Let's not use concepts. Let's just mathematically prove it. So let us do that for you. Listen, let's dive back in, but hopefully this visual was helpful for you. So now as we kind of get to the end of this, you've got what I think are two options. If you're sitting there thinking, okay, I want to see how this would actually work for me, great. Let's book a call. Let's get on a call. Let's show you the Vault. Let's show you your situation, and let's solve your problem. We'll walk you through it. That's what we're going to do on a call. Or for the rest of you that aren't ready to book a call, you're still in the stage of trying to understand this. You're still in that stage of trying to figure out how people actually use strategies like this. Well, great, I got a solution there. This video, The Secrets of the Wealthy. It is the foundational answer. It is the foundation of the infinite banking concept. And it's where you really start to open up and see how this would work for you. So those are your two options. Book a call with my team. Let's solve your problem. And we'll help you solve your problem because that's what we do. Or continue the journey of learning. And I love that. It took me a lot of learning before I took that first step. So whatever step you're on, great. It's forward progress. And forward progress is always what you need. We'll see you on the next one.